Kalshi is doubling down on commodities, announcing an aggressive market expansion and a dedicated hub for price discovery. In an era of volatile supply chains and shifting inflation signals, regulated event contracts on commodities could reshape hedging and speculation. The move matters now because institutions crave clarity and retail traders seek accessible tools to manage risk without the friction of traditional futures. By concentrating products in one hub, Kalshi promises faster onboarding, clearer pricing, and more liquidity during sudden shocks. If successful, this could redraw who trades energy, metals, and agricultural goods and influence how risk is priced in real time. Kalshi is expanding its product slate by introducing new commodity contracts and building a dedicated hub that houses pricing, trading, and settlement. In plain terms, investors will be able to place bets on events related to prices in energy, metals, and agriculture, but within a regulated exchange instead of a betting app. The hub will bundle liquid markets, deliver standardized contracts, and offer direct access through APIs and mobile interfaces. Think of this like a streamlined version of futures with simpler terms and event-driven outcomes. The goal is to convert hedging demand into consistent liquidity and transparent pricing globally. Kalshi emerged as a regulator-approved exchange for event contracts, a niche that echoes the older futures architecture from CME, ICE, and NASDAQ in the commodities world. The background includes decades of price discovery on oil, copper, corn, and natural gas, where venues use standardized tick sizes and margin requirements. The idea of binary event bets gained traction during the last commodity spikes when traders sought quick hedges on inventory, weather, or policy moves. The hub concept is a modern renaissance, pairing accessible user experiences with rigorous risk controls, governance, and audit trails that echo established exchanges across global markets. Initial market reaction has traders testing Kalshi's newly announced hub, with search interest rising and a flood of order flow in related options. As major commodity benchmarks swing, a more accessible hub could attract institutions that previously preferred futures exchanges for liquidity and margin. Market observers point to growing retail participation and the potential for lower hedging costs as a positive signal. Trading volumes in related segments have shown upticks after the news, and some energy and metal futures moved on headlines about supply constraints. The broader impact could be a step toward more democratized price discovery in volatile conditions. Industries closest to commodity price moves stand to feel the first ripples. Energy majors, refineries, and chemical producers could hedge more efficiently, while farmers and miners gain access to streamlined contracts, translating price moves into actionable risk controls. Renewable energy developers may also hedge fuel costs against volatility. For investors, hedge funds, pension allocators, and even high-net-worth individuals could diversify strategies away from pure futures into regulated event-based bets. Brokers' improved client onboarding, and technology providers anticipate easier API connections. The ripple effects may touch airlines, logistics firms, and manufacturing chains that depend on predictable input costs. Geopolitics and macro forces frame Kalshi's expansion just as risk appetite shifts. OPEC+ production decisions influence energy scar tissue and price baselines, while sanctions modify supply routes for metals and grains. Inflation remains stubborn, with central banks prioritizing price stability and tightening cautiously, which can deepen hedging demand for inflation-linked outcomes. A stronger dollar can suppress foreign commodity pricing in local currencies, yet cross-listed products and regional exchanges create opposite pressures. Trade policy signals from Washington, Brussels, and Beijing add uncertainty, pushing investors toward regulated venues that promise transparency, audit trails, and standardized risk controls amid tumbling liquidity in some over-the-counter corridors. Smart money is testing the waters with staged pilots, risk committees reviewing how event contracts fit into diversified commodity sleeves. Some pension funds and family offices are dipping a toe, while hedge funds with macro and cross-asset desks are evaluating hedging advantages against inflation shocks. Retail platforms witness growing sign-ups as education campaigns demystify contract mechanics. The new hub could accelerate liquidity by routing collateral and settlement through a single counterparty, reducing counterparty risk for complex energy and metals trades. If volatility persists, more capital could flow into these products. Institutions are also watching liquidity metrics, bid-ask spreads, and regulatory feedback before scaling. Every innovation carries risks, and Kalshi's commodities push is no exception. If liquidity fails to materialize, spreads could widen, and traders may experience slippage that erodes hedges. Regulation could tighten, limiting product scope or imposing capital requirements that raise costs. There is also model risk. Event-driven contracts rely on clean outcomes and trusted oracles. Any governance gap could spark disputes or settlement delays. Market structure could invite gaming or manipulation during extreme volatility or major policy announcements. Finally, competition from traditional futures and newer platforms could slice liquidity, forcing the hub to compete for time, capital, and credibility. Regulators may demand higher capital buffers and stricter disclosures. Retail investors should approach this expansion with education and discipline. Start by learning contract specs, settlement rules, and how events are priced, then test strategies in paper or simulated trading before committing real capital. Use small allocations. Diversify across energy, metals, and agriculture to avoid single market concentration. Set strict risk limits, such as maximum loss per day or per contract, and use stop or limit orders where available. Favor clear hedges versus speculation and track fees, margins, and hedging effectiveness over time. Finally, review performance and adjust. Use backtesting to validate ideas before risking real money. Keep emotions in check. Kalshi's Commodities Hub marks a pivotal shift in how risk is priced and managed across supply chains. If the platform delivers on liquidity, standardization, and robust governance, institutions and retail traders could find new, accessible hedging tools that reduce the cost and frictions of traditional futures. Yet the path remains uncertain. Regulators, liquidity providers, and counterparties must prove market-making during shocks. In the near term, expect more product launches, data feeds, and educational content that demystify complex contracts. Stay vigilant, diversify, and think long-term as alternative assets reshape commodity markets. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.